You're my coach. You're my investing coach, let's say. And I have $10,000 and I want to turn it into $1 million. So that's 100x or 100 bagger in your terms. What would you be advising me? How would you coach me to think about that? How would I take 10K and turn it into $1 million?
So I would make some tweaks to your thinking first about the 10K. So I would say, okay, the 10K is a good starting point. But what I also want you to do separately from that is have a day job.
Yeah.
Okay. And I want you to spend less than you're earning. And I want you to take the 10K and I also want you to take your annual savings. Maybe that's 5,000-10,000 a year or whatever it is. And normally I would say put it into an index, right? The index, like the S&P, is overheated. We can't go there right now. Okay, maybe 2035 we can, but not 2025. So what I would do is I would treat Berkshire Hathaway as the index because they have such a huge portion of the market cap in cash and they're ready to,
right.
What
makes you say the S&P is overheated?
Well, I think that if you look at the Mag 7 in terms of just trailing PEs and all of that, it's way above the S&P long-term average. But even if you ignore the Mag 7, you look at the 493 other stocks, they are also trading significantly higher than historic averages. And this isn't the first time. We've seen this story play out. So for example, in the year 2000, early 2000, there were 3 stocks that were over a 600 billion market cap. On the whole planet, there were only 3 stocks over 600 billion. They were Cisco Systems, Microsoft, and GE. And we know how that story ended. Cisco never saw that market cap again from 2000 to 2025. Company's done well, it's grown and all of that, but it was just too euphoric. And Microsoft has also done exceptionally well. But from 2000 to 2015, 15 years, 0 returns. And it wasn't just 0 returns. It went from a 600 billion market cap to a 200 billion market cap before coming back to 600. And if we look at GE, we don't need to talk about that. I mean, that just imploded. It never came back. So in general, investing in the largest market caps in a time of euphoria isn't a great recipe for success. Okay, I wouldn't want to be all in on the Mag 7, but I would say that compared to even the remaining 493, I would take Berkshire over the 493 in the S&P. So I would just say the default currently is you put it, dollar cost average into Berkshire Class B shares, right? And you keep doing that day in, day out. Now, the thing about investing is that opportunities are not going to show up just because you have the cash. Okay? So our plan A is just keep putting money into Berkshire. And if we did that, even if we were doing 10% a year, right? I mean, which I think is pretty reasonable for Berkshire. Rule of 72, we would double every 7 years. And we went, let's say we are a 20-something guy with 10,000, and you go for 50 years or 49 years. It's 7 doubles. Okay? 7 doubles is 128. Okay? It's 128 times your money. I gave you more than 100x.
Right.
I gave you 128x in 49 years.
Without having to be a genius.
Without doing anything, right? So this is just plan B.
Right.
Where we put the 10,000 in, it becomes more than a million, 1.33 million. We haven't even gone to plan A yet, right? This is just sitting there. Now, the other thing is that every once in a while, there'll be opportunities that show up. And what we're looking for is something that hits you in the head with like a 2x4. So the best investments are ones that make no sense. You cannot make sense of the numbers. It's too good to be true. It's just weird and all of those things. So when these kind of unusual things come together where things don't make sense,
right,
that's when we want to dive in.
Give me an example either from...
In the year, I think this was like around 2001 or 2002, I had encountered this shipping company called Frontline. And Frontline was a company that owned a fleet of about 75 VLCCs, very large crude carriers. These are giant ships that transport crude from like Saudi Arabia to the US, and they're just huge. The entire global fleet at that time was 300 ships, 300 VLCCs. 75 of them were owned by Frontline, 25% of the market. The guy who ran and was the founder of Frontline, John Fredrickson, had put the entire fleet on the spot market. So there are two ways he could have dealt with his fleet. He could have done time charters, kind of 1 year, 3 year deals where he's guaranteed cash flows per day and all that, or be a gambler, put it on the spot market and play it.
Whatever the price today is,
right?
I'll take it.
So he had put it on the spot market, the entire fleet. Now these VLCCs, they have a cost with the crews and all of that of around $15,000 per day to break even. That's the cost to break even. And at that time, we had like the Iraq war and different things going on. So oil demand fell a lot. And there wasn't enough need for VLCCs. So the shipping rates collapsed to the point they went to 7,000 per day. Okay, so now you have Frontline losing 8,000 per day times 75 ships. Right. Okay, and they're levered. Okay, and so basically the stock got taken out back and shot. Okay, like a 90% drop. Okay, and most of it was valid because basically, you know, when we are making investments or when equity markets look at a company, they want to see consistency of cash flows. They reward consistency of cash flows. Here, what we were seeing is consistency of losses. Okay. No one could tell you when these losses will abate. So the dynamics were the stock, I think, was down to like $3 per share. And when I looked at it, I noticed two things. Okay. The first thing I noticed is all their debt was non-recourse. Their debt was tied to individual ships. There was no debt at the parent. So basically, if they defaulted on the debt of a ship, the bank could just take the ship. They couldn't really take the company, could just take that ship. They take a car loan. And the second thing I noticed was that even when the rates went to 7,000 per day, the ships had dropped in price by something like maybe a third, 25, 30% drop from where they used to be.
Right.
So what I realized is that if Frontline got into a crunch where they were having cash problems, they could just sell 3 ships. If they sold 3 ships, paid off the debt, they'd have enough cash left over to keep sustaining operations for 6 to 9 months. They could sell 3 more ships after that. So I felt like there was really no way the company was a candidate for bankruptcy. And the other thing is I could look at the entire company and say, okay, what if they sold all the ships? If they sold all the ships, paid off all the debt, you would end up with like $9 or $10 a share. You're at $3. So you make 3 times your money if they just liquidated the whole business, right? So I said, okay, we really can't lose money here. And we're going to go buy Frontline. So I put 10% of my fund into Frontline, right? Because I just couldn't see a way that we could lose money. Now, when these rates were at 7,000, what happens is scrapping of ships skyrockets. So there are these Greek ship owners who have like 1 or 2 VLCCs. They're like 25, 30-year-old rust buckets. Yeah. So they send them to Bangladesh or India to be broken up, sold for scrap, get 10, 15 million out and go do something else with the money. Right? Because the old ships stop getting rented because they're single hull. Right. After Exxon Valdez, everyone wants double hull ships. So all the single hull ships are getting scrapped. So now the fleet went from 300 ships to about 250 ships. After a few months, the rates start improving. The oil demand starts coming back up. The rates go to 15,000. Then they go to 20,000. The stock's at $10. Okay. I sell my shares. Well done, Monish. Okay.
Tripled my money.
Yeah, in like 8 months or something. Okay. And I said, okay, this was exactly what I thought, right? Rates then go to 300,000 a day. Okay. At 300,000 a day, they're making something like 285,000 a day times 75 ships. Okay. That number is like infinity. Okay.
Yeah, I was trying to do the math.
Just assume it's infinity. The stock goes up in the next 3 years, 80x.
Oh, wow.
Okay. Here's stupid Monish, okay, patting himself on the back with the double. And I didn't even get a double. I got like 80% return on my money, and that was that. And so that was an example of where I did first order thinking, but I did not do second order thinking. So the second order thinking was, Buffett always says that the most important question to ask in investing is, and then what? Whatever you think, then you say, and then what? And you keep asking that, and then what? If I had been so smart as to ask the question, and then what? So you see that rates are terrible. You see the scrapping. You see that fleet's going to shrink. So even if oil demand doesn't come back the way it was, it's going to come into balance. Eventually, those losses are going to go away. And then you do the next thing on then what, which is that when oil demand comes back, it takes 3 to 4 years to build one of these things. So when the rates went to 30,000 or 50,000, and all these guys can see this is a great business now, well, when you go to the Korean shipyards, who are now inundated with orders, they're going to say, go to the back of the queue. I'll give you a ship in 5 years. And by the way, the ship is no longer 70 million. The new price is 120.
Right.
Okay. Because I got more orders than I can handle. Right. So we had this dynamic, if I had thought about it, that once the demand became tight, you really couldn't increase supply for at least 3 or 4 years. So what's 285,000 times 75 times 1,000 days? That's the minimum number of time when that price is not going to come down. It's only after 3 or 4 years, more ships start getting delivered and you start getting more balance and all of that. But that's an insane amount of cash flow, right? So basically, if we are plan A, Berkshire Hathaway, plan B, looking for anomalies, right? Every so often, not very often, every so often, you will find something weird. We can research something for 3 months. It turns out it's not that great. Let it go.
Right.
We got Berkshire still cranking. Okay. So if you look at Warren Buffett, in his 2022 letter, he said that in 58 years of running Berkshire, there have been 12 decisions that have moved the needle for Berkshire stock. Now, in 58 years, he made more than 300 or 400 purchase decisions for stocks and businesses. Okay. Out of 300, if I take a conservative number, it's actually more than that, only 12 were exceptional. And he said there was one good idea on average every 5 years. Okay. This is Warren Buffett.
Right.
With a 4% hit rate. Okay. So basically, great investment ideas are rare. We're not going to run into them every week or every month or every year. So plan A, stick it in the index. Plan B, keep running a Geiger counter over everything, looking at different things. And when something doesn't make sense, drill down. And every so often, you're going to hit a mother lode.
Right.
And when you find something that's a mother lode, you peel off 10, 15% of what you have in Berkshire, put it into that, let it play out, then put it back into Berkshire.
Right.
Right. And just you keep doing that. And now your 100x is going to show up in half the time or less.
Michael Burry. One of my favorite movies is The Big Short, and Michael Burry is this kind of mysterious character. Did you ever meet Michael Burry?
In 2008, okay, so the financial crisis is not yet happened. It's like March or April of 2008, right? So things are getting topsy-turvy, right? And I was visiting San Jose for something. I was going to San Jose, and I knew Michael Burry had an office in San Jose. And I didn't know him, but I sent my email saying, Mr. Burry, I like you, admire you, etc., and would love to visit you. And he said, oh yeah, stop by. Okay. So I go to his office in San Jose. It's a very seems like a very depressing place. Okay. It's kind of a little dark and there's a few analysts there. And then I go into the office and there's huge piles of paper everywhere. And he immediately launches into CDSs. Okay. And he says, look, Monish, I want to tell you something about something that's going to make you extremely wealthy. Okay. He then downloads to me at 1 million miles an hour I've never heard of a CDS. Okay. And he's talking about housing crash and the coming implosion and all this stuff, and 80%, 90% of what he said went straight over my head. Okay. Like he just gave me a full core dump in half an hour. My subhuman intelligence couldn't handle it. Okay. I couldn't. And, so I come out of the meeting, my head is spinning and I say, okay, well, that was interesting. Okay. And then, of course, he rides off into the sunset, right? And then the movie comes out, right? And I felt like, okay, God, who loves me so much, takes me to the epicenter of what would have been the best place to be.
Right.
The best teacher to have. And the idiot Monish blew it. Okay. But that's the way it is, I think this has happened to me a lot. Like I said, we put 98, 99% or too hard pile, right? Even now, I think it was right of me to not do anything with it because I couldn't understand it.
Right.
Even after the financial crisis, it took me a while to understand the CDSs.
Right.
And even after knowing all that, I would have been skeptical about making that bet. So hats off to him.
Right.
I mean, he figured it out. A few people figured it out, but it was a very small number of people who figured it out.